AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. You can always reach out to us, Tony or Gordon at BayAreaLoanSource.com. Call the show, 800-516-1220, 800-516-1220. We'll repeat that number occasionally throughout the show. You can always stream on KDOW.biz as well, and you can also get the podcast at our website. Mortgage rates are, we came into 2021 with almost record low mortgage rates, and they've been kind of ticking up a little bit since, was the election, of course, and then we had talks about the stimulus check, and it looks like that's going to go through, and that's pushed up yields on the 10-year, which is kind of the underlying, index behind mortgage rates. Freddie Mac has the weekly survey for the 30-year fixed at 2.79%. I expect that to be a little bit higher next week. It was 2.65 last week, so it's an eighth increase. About 112 basis points or so in rate, and that's translating it slightly higher. And we talked last week about, maybe it was the week before, about some of the predictions that, like Realtor.com and some of the larger entities out there predicted mortgage rates will end at the end of 2021, somewhere in the lower threes. Most of them said, and it's not. We started off a little bit. We're going to see the volatility until after the inauguration, and we start seeing these checks and see how it plays into the economy. But what are your thoughts on how we saw such an immediate increase on just a small amount of money going to each American when it's, in the big picture, but yet mortgage rates are translating into much higher payments for people who are looking to refinance or purchase?
Well, rates have ticked up this week. Got a couple of panic calls for some customers that people that, as we predicted, are on the fence, that are always trying to time the market, waiting for rates to come down to rock bottom. And this week it kind of threw everybody for a curve. Rates went up, and we had some locks that were expiring, and now to extend those locks, it costs an arm and leg to extend, and customers are beginning to complain. These are all the things that are part of our business that happens all the time when there's changes in the marketplace that's kind of unexpected. As human beings, we kind of get spoiled. Wherever things are going in one direction, we believe they're going to continue to go in that direction. Same thing will happen in rates. But the stimulus checks are coming in. I was just looking online, tracking a couple of customers. We were just talking about online tracking where their payments are. Monies are going out to homeowners and Americans. Hopefully that money is going to translate back in the economy, and it's going to kind of take us through this little rust spot that we're in. COVID numbers are, if you listen to the radio and television, are outrageous. And maybe it's not, I told a customer this morning, maybe it's not that they're outrageous, just that finally we're testing people. So now the number is a lot higher simply because we're testing more people. The vaccine is kicking in. Joe Biden said that that's his first priority when he gets in office, his first 100 days, to make sure that every American will be vaccinated. So we got a lot of things to look forward to during this rambunctious next probably 30 days with this whole thing with the president and the impeachment. A lot of nervousness in the market, and when the market gets nervous, rates kind of tend to go up just to kind of make sure they're not showing which direction they go. Rates always tend to go up in any period of volatility or uncertainty.
Yeah, so really when we see that normalcy, Gordon, is what you're saying, is when we can really predict a little bit better where rates are going to go. And they could come back down, and they will go up and down. That's all they do. You go back in history and you can see all they do is go up and down, and we will see that and end up with something at the end of 2021, and hopefully it stays and keeps the affordability range for most Americans in the United States looking to buy a house and looking to refinance and shave off a little bit off their payment, maybe pay off some debt. We have places all across the United States, Gordon, and we're going to hit this list at some point where people are moving. People are moving all across the United States, and investors are looking at opportunities in these areas. We even have other investors here that are looking to buy more property, cash out refinances, on properties that they've been seasoning for years, looking for opportunities like we have now with the low interest rates to buy more real estate. They're active in these places across the United States. We're looking for that normalcy, but at the same time, we have a select few. We have people who are making money, and then we have people who own houses that are taking advantage of these low interest rates. And then, the rest are left to with this pittance of a stimulus check. Is it really going to get normal? I think it's the question.
Well, once again, we always got to make sure what is normal. I think normal is not what it used to be. There's a new norm we're actually establishing. I think we just got to get accustomed to the current circumstances, the current environment where we're in right now. I think if you look at where we are now politically, economically, there's a whole lot of reveling in our marketplace. A lot of uncertainty. There's a lot of change, a lot of challenges that we have right now. As we talk on the show all the time, there are a lot of hard questions and very few easy answers. So I think we got to work through this thing. There's only one way to get through it. We have to learn how to work through it. We went back just now. We fell back in our old cliche. We always talk about rates going up. Rates never goes up, as we always say. The cost of rates go up. So we just need to make that correction. So when we say rates went up, it's not that the actual rate changed. It's just the cost to get that rate went up. So in other words, if you were looking at a 1 point cost on a 2.5% 30-year fix, not to tell you, you're probably looking at a 1.5 point cost. So the rate stays the same, just the cost of buying a rate kind of escalated. So that we just want to make that correction, make sure keep you on the same page where we are, understand how we think, how we see things, how we see the marketplace, and how we try to make sure that our customers and our viewers and our listeners understand what we're preaching, so they can go out there and take advantage of the news and all the information we have here in the studio.
Some of the highlights from December: Tacoma, Washington was the fastest market with half of all homes pending sales in just 6 days. That's down from 21 days a year earlier. The most competitive market in December was Oakland, California, where 68.1% of homes sold above list price, followed by San Jose and Tacoma, Rochester, and Buffalo. Oakland, California has the largest share of homes predicted to sell at or above list price moving forward at 91.1%, and San Jose is second at 87.8%. So here in the Bay Area, Gordon, I mean, yes, low interest rates help, but for somebody who's looking to buy a house, whether they're buying their second house or a third, or they're buying their first home, you're looking at some significant competition. What are some of the things that we've been seeing successful buyers do to get into these properties in such a seller's market?
Well, we always talk, but you have to be, we lose the old Boy Scout cliche. You have to be prepared when you're looking to buy a house. It's a very, very competitive market, and believe us, from what we see, from all the shenanigans, sellers always tend to go at the higher price at the end of the day. But they also want to make sure that even in going at the higher price, that you are actually qualified at the higher price. So a lot of times is, if you don't get your offer accepted, even though you're at a higher price, there was a guy probably a tad below you, but he was more prepared. He had his approval. He had proof of his asset. He had no contingencies on his contract as far as the appraisal contingency, no contingency on the inspections. That's what they're looking to see. They're looking to make sure that when they dot that I and cross that T and execute that contract, that you are going to be able to close in a short period of time. These guys are looking for 30 days or less on closings. I think if you have those ducks in order, you will get your contract accepted, and you'll be the new homeowner of that specific property you're actually looking at.
63% of 2020 home buyers made an offer sight unseen. I think that's something else that you need to be prepared for when you're looking at a certain neighborhood, maybe several neighborhoods in a particular area, that you have to be ready. I think you need to just not only just say, I want to buy a 3 and 2 with a garage in this school district. You need to go out there and literally see these neighborhoods. You need to be prepared, saying, oh, I know that street. I know that, oh, that's good. I like that one. Let's go online. And you need a realtor to help you be able to do this and put that offer in, and realtors must be going crazy right now with just the amount of, this activity online. You have to be, it could be 8 o'clock, 9 o'clock, 10 o'clock at night that you're putting these offers in. That's the kind of preparation that I would be expecting in a transaction today, in this area.
And one of the things we always preach, we preach that you should always work with a local realtor. I think realtors like to know that people know the marketplace. They don't like to see you coming in with some guy out of San Jose when you're buying an Oakland property, even though you might be the highest offer. At the end of the day, when you're trying to put your best foot forward, you want to use all your assets. You want to put everything forward to make sure you get your contract accepted. And local realtors could be the difference. Sometimes the realtors, like it or not, if they worked with another realtor before and they got positive results and it's something close, they're going to recommend that realtor that they know is going to perform, they know the buyer's going to close, and they know there's not going to be too many hiccups. It's a very competitive market. You have to make sure that you are prepared if you're looking to become a new homeowner in a house.
Surprisingly, a lot of people still are not prepared on the loan side, or they get overpromised. The overpromised ones, Gordon, we get people who have been rejected after going through the process of getting an offer accepted and saying it was declined eventually at the lender. That means they weren't prepared. They didn't get the right pre-approval. They didn't. The loan officer or the bank, whoever did it, did not do enough research and ask you enough questions and get you far enough far long enough in that process to help you make that right decision. That's what we're here for. That's what we do. I've been in finance for, I have to go back to 19 years, 20 years almost. And you've been in real estate for
20 plus
years. You need the professionals in this industry. In fact, there was one statistic I saw that a lot of people are going away from using small brokers to the big brokers. I wish I pulled that number up because they do have more technology. They have the way to get you that sight unseen offer. Now, of course, if you go in there and say, I want an inspection contingency, you eventually get in the house and you see it. Leave one trap door open or one door open to get out of the contract. But I can tell you that a lot of people are just foregoing that, and they're going right into these sight unseen offers, Gordon. How many have you done this year with sight unseen?
Well, actually, when you say sight unseen actually is change. An old sight unseen and today's sight unseen is a little bit different with virtual tours and everything that you can actually look at these properties from the outside in, from your home, from the luxury and the comfort of your own home. You can actually do a virtual walkthrough in this property. You can go to Google Maps and look at the surrounding, look at the neighborhood, look at the aerial map. So sight unseen is a little bit different than what it used to be before. So I think you can be a lot more comfortable when you're looking at a property that's sight unseen. You haven't seen it. You look with the neighbor's property. Matter of fact, we were dealing with the client the other day, and she said, well, the realtor referred her to us. We looked at this beautiful property, and she called back. She said, you know what? I don't like the yard of that neighbor. The yard is messy. I'm not interested in that property simply because just by looking at the aerial map and see what that neighbor's property actually looked like. So a lot of different things out there. Technology is something you got to really, really hold on to and grasp if you're trying to take advantage of the marketplace, because technology is where it's going to be and how it's going to get you from point A to point B. At the end of the day, get you in that property.
So the sellers are embracing this as well, and they're realizing that you look at stats like this, that 3D monthly views of 3D walkthroughs on Redfin, for example, have increased 563% since February of last year. This is the technology that people are using. This is the technology that your realtor should be embracing. It's certainly what we embrace, and we're looking forward to 2021 as many people expect this to continue throughout the rest of the year. And this is the new norm, Gordon, that you keep talking about.
Absolutely.
We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. Also can send us an email, Tony or Gordon at BayAreaLoanSource.com, or call the show, 800-516-1220. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're always welcome to shoot us an email. Get your questions on the air, Tony or Gordon at BayAreaLoanSource.com. Or you can call the show, 800-516-1220, 800-516-1220. We do get an email here. This is from Sarah. Now, I love this email because, we have this massive generation of baby boomers that are either retired or looking to retire. This is from Sarah. She's 70 years old and lives alone. I have a very few expenses, but they're going up slowly each year. I have a small mortgage that I've been paying on for about 8 years. I got before I retired. So it looks like she retired while she had some income. And now she feels the payments are too high with my new expenses. Can I use retirement income and Social Security to qualify? This will be my first refinance since I've retired. So the short answer is yes. You can. You can use Social Security, pensions, IRA distributions, annuities, etc., to qualify. In fact, if you have assets too, and you're of age of retirement, you can use assets in a program called Assets for Income. You don't actually deplete your assets or use the assets, but they calculate, basically take your assets and divide it by the term of the loan, and that creates an income as well. So there are other ways that, without having a W-2 or self-employed job, you're retired to qualify for a loan.
And that's always a challenge with people that are on fixed income. You're on a fixed income, but the expenses that are fixed continue to escalate. I was looking at my tax bill just last week, and the taxes went up 7%. So if I was on a fixed income and my taxes went up 7%, have the same amount of money coming in, of course, it's going to put a financial strain on my budget. Insurance goes up, cost of upkeep goes up, everything goes up every year. Inflation, money is actually valued at less. So it was a struggle for people that are in fixed income to maintain these properties. And that's one of the reasons why we always talk on the show, the reverse mortgage became very popular, because what it does, it wipes out her obligation to make a monthly payment. Of course, she's accruing interest and she's adding on interest and back payments onto her balance. But if she doesn't have any kids or anything else like that, and that's the only resort, sometimes that can be an actual formula for that specific situation she was just talking about.
Yeah, and in her case, she's had it for 8 years, and she's paid down 8 years of the balance, and she can reamortize with qualifying with this income. Hopefully, she's kept her credit score good and her debt nice and low, so she'll qualify. And yeah, a lot of people get to retirement, and we're talking about Generation X and Generation, the baby boomers. They're looking to get, talking about retirement or have already retired, and whether or not they're going to pay off their house prior to retirement or they're going to carry a mortgage. My dad, for example, he made enough money and had enough money to pay off his mortgage, but money was so cheap. Rates kept going down. He had a rate of 15% back in the 80s, and that's slowly, every time he refinanced, it went down. And his last rate he ended up was like 3.25%, and before he sold the house. But he kept a mortgage till he was 75 years old. Or you pay off your house. Which one is the better way? A lot of people now are starting to think well in advance, and as they should, of whether or not they can get on a schedule to pay off their mortgage, Gordon, before they retire, or do they need to carry debt throughout retirement? And that's becoming a major financial tool now. We have a lot of financial planners that call us and go through these scenarios, and in many cases they're saying, you know what, the 30 years better going into retirement because it fixes in that payment for so long at these low rates.
Well, it no longer has to be an enigma for what people need to do. I mean, there's all kinds of resources out there. There are financial planners, which we highly recommend, a professional financial planner. There's all kinds of help you help yourself tools on the web that you can kind of forecast and plan. Because a lot of times what people don't realize, once you stop working and now you're looking at a fixed income, some of the fixed incomes have what they call COLA increases, but the COLA increases sometimes is maybe 1 or 2%. But you're still burdened and struggling with expenses going up. It becomes a real struggle as you go deeper into retirement on a fixed income. Then it's really begin to draw on the money you have set aside. So it's not as easy as it looks. It's always good to get out in advance, start pre-planning, start thinking about it. I started thinking about retirement the last couple of years, even though I'm not at retirement age, because I know it's coming, and I just need to get myself not only mentally prepared, but financially prepared if I'm going to stay in the game and try to stay in the property I'm in right now on the fixed income I will be receiving like everyone else.
You could read into this a little bit more, too, and maybe Sarah retired with a spouse, and now the spouse is no longer with her. And now she has to figure out how to, maybe she would have mentioned that, but there are situations where that happens. And now you're left with, less income and with the same expenses in many cases. So I do truly believe that there are some, you have to make that decision at some point. Are you going to pay off your house before retirement? Because when you get to that fixed income stage, especially if you have an IRA, a lot of people are now retiring that weren't in the era of pensions. They're looking at IRAs, and stock markets go up and down. Right, and maybe you're managing it on your own, and you don't have a planner that's giving you a kind of a guideline and of payments of what you can receive, whether it's safe money or your interest or annuities, however you're getting your money, and that's going to be fluctuating now a lot as more and more people with these IRAs or Roths that are just too volatile in some cases.
Or you can retire at the wrong time. If you retire with the market, and the market has crashed, and your assets that were let's say $2 million, and now because of the downturn in the marketplace, you're looking at $800,000. That could be a real financial wrench in your portfolio. I had a client the other day that called. She was living with her daughter. Her daughter was a young attorney. It was working out really nice. Daughter fell in love with a guy and got married, and now is moving out of state. And now the daughter now is saying, listen, Mom, I'm moving out of state. She's going to have to pay for the house now. The daughter was paying half the rent. And she says now she's got her own house. It's a different thing now. So she can't expect her daughter to pay half the rent anymore. So now she probably has to look at a roommate situation in order to maintain that financial stability in that property, or she might have to sell it. So a lot of things do happen. Things don't always go as planned. I know we plan for things, but the one thing about retirement, they say most of us fail to plan, or the other half of us plan to fail. But there are different wrenches and different challenges come in our formula, and we just have to have a formula plan to work through it, or else it can lead to financial ruin, financial disaster.
As we see these low interest rates continue through 2021, hopefully in the range they are now, it gives people these opportunities, Gordon, and that's really what it's all about: is opportunities to save money and get better planning. And that's just one scenario that had how many variations? Many. That's just one type of scenario. And it could be almost anything, whether you're cash out. We have a lot of people looking at doing additions, or they're paying for their kids' college, or they want to buy more investment property, or they're just paying off credit card debt, or they just want a lower payment, or they're shortening their term. We have a lot of people now that are looking to shorten their terms with the 15-year right now. It's at 2.23%, according to Freddie Mac's weekly survey. If you've been in your loan for a while, and you think you're on a great schedule towards principal, it could be this Sarah. She's been in 8 years. Maybe you look at a 20 or 15.
Or a lot of people, Tony, we talked earlier. We were talking about a client earlier that's building the ADU in her backyard. She's looking to build the ADU to bring some additional rental income because she wants to stay in that property. She said, as push come to shove, she's actually going to move into the ADU and rent the front house because it's going to make more economic sense. Once again, as you move towards retirement, you have to make different changes. You have to make different plans in order to stay where you're at, because as we know, California is one of the highest places to live. Cost of living is high, taxes is high, insurance is high, groceries are high, gas is high. So we really need that income coming in order to maintain our house and keep our status quo the same. And we have to make different changes. That's one great way of looking at ADU to bring some additional rents, even though it's a single-family house in a single-family neighborhood.
That's an interesting one, because there's a lot of options being thrown around for ADUs. Whether you build it or you do a garage conversion, or you put a unit in the back. There's a lot of companies now that are saying, "Oh, we're going to just drop one in the backyard for you. You can pay us a certain amount of money, and you don't even have to own it. We'll own it, maintain it, do everything for you." A lot of interesting options out there for people. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report. You can always call the show, 800-516-1220, 800-516-1220, or shoot us an email like Sarah did. Thank you very much for the email. It's Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We'll be right back on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Mortgage rates continue to be in the headlines. 2.79% on the Freddie Mac weekly survey for the 30-year fix. They'll probably go up this week for the next week's survey, since we saw some activity we saw a sell-off on the bond market, and that created higher yields, higher interest rates, all kind of based on we saw some employment numbers. They didn't hit their target, but that was offset by the stimulus news that we heard from Biden. So it's right now, rates are volatile, meaning they're going to go up and down a lot until you figure out if it makes sense for you. But I don't think there's a big rush right now, Gordon, for people to grab and just a rate. I think you can sit back a little bit and float while it happens, but you will see larger trends of up and down, though. That's what I believe we'll see.
Yeah, I think we're going to see a lot more volatility in the marketplace, simply because of the uncertainty in the marketplace and the environment. As we kind of work through it, and probably work through the first quarter, I think we'll start to see either things become more settled, or we'll see more volatility. Speaking of rates, I found this old newspaper in one of the desks. This is a newspaper going back for the Oakland Tribune back in May 1997. And it says that Fannie Mae average mortgage rate was 7.94, up from 7.92 last week. So what a difference a year makes. That's 1997, 7.94 versus where are we right now?
2.679.
Almost a 5.2 swing, lower swing. So just imagine how much more house you can buy with that difference in rate. It's an incredible place to be in. Prices, of course, have gone up. I don't know if you can call it the balancing act, but at the end of the day, that's where rates were back then versus where rates are today.
Here's the results right here. The national median home price, sale price, rose 13% year over year to $334,000 in December, as home buying demand continued to rise because of low interest rates and the lack of inventory. Inventory is at all-time low right now. But some of the interesting things here is we saw listings increase, Gordon, in certain areas of the United States. In particular, the top two, San Jose, Sunnyvale, Santa Clara, that's a metro area, and San Francisco, Oakland, Hayward is another metro area. They hit the top of the list, according to Realtor.com. 123.8% of new listings year over year for San Jose, Sunnyvale, and 98.9% for San Francisco, Oakland, and Hayward. That's good news to see more inventory hitting the market, especially this time of the year.
Yeah, more inventory, of course, bring more buyers to the market, keeps those multiple offers down, keeps property prices down slightly. I guess it tantalizing question you want to ask yourself: do you want low property payments with higher rates, or do you want lower rates for higher property payments or higher property values? That's the question you have to ask yourself.
I think a lot of people would rather have the lower rate because it's locked in for 30 years.
Then
in my
if
opinion.
if you have the higher property prices, your property taxes.
I'll
are
run the
higher.
numbers, but I think it's about $50,000 per quarter, I believe, as far as buying power. So you have to look at the buying power of a 0.25% interest rate each for each step there.
Okay.
So we've done the analysis before, and there's been a lot of analysis on this. We have the information.
Well, I hope you're not plucking that number out of a hat. That's all.
No, I'm not. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. You're welcome to give us an email or a call, 800-516-1220. The email is Tony or Gordon at BayAreaLoanSource.com. We'll be right back. This is the Real Estate Report on AM 1220 KDOW.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
So instead of calling me, pulling these numbers out of my hat, $40,000 is about a 0.25% in rate or $174 in payment. So that's what that means. So a 0.25% in rate on a $500,000 loan can mean that you can borrow that much more.
Okay.
All right, for payment wise, and that translates into more buying power or less buying power. So as we see these rates go up and down, yes, we did see them come down considerably all of 2020 for the most part, ending the year practically at all-time lows. And that's the reason we see 13% increase year over year from December 2020 to 2019 in the United States median home price.
All right, so using your formula, $40,000 is equal to a 0.25%, right?
Well, for a $500,000 loan.
Okay, yes. So on a $500,000 loan.
Right.
Okay.
So it depends on what your loan amount is, but it does equal buying power. All right. So what they would do is they would take the median price with 20% down and they would translate it. That's how they do the analysis. But for somebody, in the Bay Area, a $500,000 loan is
not a lot.
It's not a lot when you think about it. Yeah. We had a client the other day. He's probably listening. Said he was going to go and finally got sick of living in a townhouse and wants a yard. And he's doing what a lot of other people are doing, and he's going farther out. He and his wife can work from home, and they're going to go as far as they can to find a certain priced house. In this case, $700,000, and they have money down. They can go as little as 10% because they've raised the conforming limit. And there you go. A lot of people are doing this.
Yeah, we talked, and right in the end of the year, we had a lot of clients that were running out to the Antioch, the Brentwood, the Oakley area, simply because the houses out there were spread out. You get big houses with pools, and those houses out there are beginning to skyrocket in value. Those houses out there are around average $800,000 now for a 4-bedroom house, 2-bath. So these things change as the market changes, opportunity changes. People think different. People make different moves. People are moving up to Tahoe, up to Reno, moving up to Sacramento, moving into different areas just because they can, and just because working at home now is an option where it wasn't before. There's no more commute. It can just change your whole dynamics of what you do daily and how profitable or how you can change your life basically from working home. It's an interesting concept, and we'll see where it goes from here in 2021, how far it goes, I should say.
Here's the quiz, Gordon. Where are people moving to? Per state, the number one state in the United States where the percentage of movers are actually staying in the state, what state is that?
Probably California.
Texas.
Okay.
93.5% of those who were surveyed that were looking to buy a house were staying in the state. Last on the list is New York. The number one destination in the United States is, for people buying a house out of state,
Arizona?
Florida is number one. Texas would be, and that's a lot of East Coast, and then Texas would be the number one destination for most of the people in the West, including California. They say 85.4% of people that are looking to buy are staying in the state, and 14.6% are moving out of state. The number one destination, 14% of those 16% are looking at Texas. Yeah, so a lot of Californians moving to Texas.
Well, Florida has always been a destination point from people in the North, the Northeast, and the Midwest. Arizona has been a retirement destination point for people from the Midwest on West California, Oregon, those kind of places. It's kind of interesting that Texas has now gotten thrown into the mix. And I know one of the big downfalls with Texas, of course, is property taxes so high. But I think like Arizona, don't have no state income tax, so that's probably the trade-off. So I guess once again, it's a balancing act. You just got to make sure you do your homework. Just because everybody's moving there doesn't mean you mow and pack up and start heading to cowboy land. You just got to work it through and kind of talk to your professional your tax person, your person that can help you out to make sure that the numbers do pencil out. Sometimes when we look at just the cost of housing, we might make bad decisions. You got to look at overall quality of life, cost of living, recreation, all those kind of things factor in when you're looking to retire.
So this was funny. The people leaving Oregon are going to Washington. Where do you think the people from Washington are going?
Don't tell me Oregon.
They're going to Oregon. So there are some flaws in these statistics, but people are moving around. And, the whole work from home thing, most of the people that we've been working with recently are working from home. We have a client that's moving down to San Diego, but his work is up here.
And a lot of that stuff has made our job easier because when they work from home, they have fax machines, they have scanners, they can scan us all the information. So it makes our job easier as far as retrieving information. Interesting dynamic how things have changed and how we're actually benefiting from these changes simply because now people are working through it. I think a lot of the irony has gotten worked out from what happened when COVID first hit. I think in early March is where we saw the dip in the market. And now people have retooled themselves, refigured out how to do it. And now I think in the early part of 2021, it's well factored in. And that's why we said that the new norm is what we established now versus what we came from.
I think I mentioned this not too long, maybe somewhere in the middle of 2020. What would have been like if this happened 5, 6, 7, maybe 10 years ago, where we had COVID and we had to work from home? I mean, the technology wasn't quite there. The virtual tours wasn't quite there yet. The technology at the lenders wasn't quite there yet. I remember the day when all of our packages that we sent to, the lenders to get your loans funded was done by what was it called? Transbox. Yeah. We would literally be dropping your documents into a box that's sitting on the street. That's how crazy it was, and that's how much we've changed. But can you imagine what it would have been like if we had COVID 10 years ago? It would have been a nightmare.
Well,
I think you can take this as a silver lining for 2020 that the people, if you had low rates but you couldn't get them, what's the purpose of having low rates? We can get them now because of the technology that we have.
Well, I think the human being, we're resourceful enough where we would have figured it out. But of course, technology has made it easier to figure it out. But if we'd had COVID 10 years ago, even though the technology that we're using now is not quite in place, I think we would have found a way how to work through it. We'd have done a whole lot of different things. Maybe have like messenger services that people are just couriering stuff around. I just like we just talked about Transbox. Transbox actually went out of business because we had a document with an overnight service. It was paid for by the receiver. So you would find people just transboxing one piece of paper. Of course, it wasn't cost efficient for the receiver, but it was very cost efficient for the person dropping the box. You find the latest transbox, one with the last pickup. You make sure your item got there. You be sure it was there at the next spot the next day, which was a very, very effective service.
Technology certainly made things a lot easier, yet California still is not. And we were hoping 2020 was the catalyst there to move us to virtual signings. It's not quite there. I think there's only 14 or 17 states that do it. I think that's going to grow as the technology grows. But I think California will be the last one that does virtual signing.
Well, California's a bigger state, I think. A lot of times as California, bigger states like California we tend to have a lot of fraud, a lot of different things we have to work through. So I think it might be last to join the union simply because of the mechanics what we have to actually work through to make sure it is safe and make sure it's very, very appropriate for the marketplace. Everything has to be customized. What we can do here, we can't do in other states. What other states can do, we can't do. Simply here, we're a massive population. We have a lot of restraints as far as travel is concerned, timing is concerned, a lot of different things here that we have to deal with where some parts of the country don't have to deal with. So we have to make those adjustments when we look at technology. We're looking at what works best for our residents here in California.
Do we have time for an email?
I think we always have time for an email.
I don't know if we spoke. Oh, we have 1 minute. You can always send us. We'll hit this when we come back after the break. But you can always shoot us an email, Tony or Gordon at BayAreaLoanSource.com. We love getting the feedback from you on this. Speaking of feedback, I do want to hit this. The Federal Housing Finance Agency, they're seeking comments for those people who have bought a house or refinanced anytime, it doesn't matter. You can go now to the Federal Housing Finance Agency website and you can give them comments. They're looking to overhaul the whole appraisal process and they want your comments. If you shoot me an email, I'll shoot you the link where you can send your comments to. That's Tony at BayAreaLoanSource.com. That's Tony at BayAreaLoanSource.com. We all need your feedback. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. Call the show 800-516-1220.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. You can call the show 800-516-1220, 800-516-1220, or email the show Tony or Gordon at BayAreaLoanSource.com. This is an email about investment property refinance. I'm considering and listen to this one carefully, Gordon, so you can answer. You have a lot of property. I'm considering refinancing a rental property I've owned for 20 years. About 10 years ago, I took some cash out to buy another property and have since knocked off about $200,000, leaving a $400,000 loan. I'm still cash flow positive on the property, but it appears that after pulling out the cash to buy the other property, I'm not going to be able to pay this house off before I retire. I like the rates today, and the payment would drop about $1,000 a month if I refinance, but I'd have to go to another 30-year. I'm 53 years old. What would you do?
Wow. Well, I think a lot of times it's hard to give specific instructions based upon such a limited
I think that was a pretty good email there.
Well, the 53, I don't know what the financial situation is. $1,000 a month is a great thing to add to any balance sheet as far as cash flow is concerned. But of course, now you're adding another 30 years onto your mortgage. She has about, how many years does she have left?
Well, he's 53, so let's say 12 years,
okay,
maybe.
So she's got 12 years. If she's got 12 years, and if I believe she could hold off for it, unless it was a dire emergency, the benefit is going to come to paying off the house. If it's a single unit, I would take the lower rate. If it's a multi-unit, I would definitely take the cash out. So in other words, if it's a one-unit building,
you would keep the current loan, not refinance it. They've already taken the cash out. They want to know if since they don't think the house will be paid off by the time they retire, to get that benefit of a free and clear house with rents.
Yeah.
Right? To supplement their income. Why don't they just refinance it now to get the lower payment and just do something else with the cash, maybe build an IRA or something like that, fund their retirement. So I think this goes back to the original email that we had. Should we refinance before retirement or in retirement? I think this other person, I think it was Sarah, said that she made a mistake and she didn't get a low enough payment going into retirement, and her bills have been going up. In this case, this person doesn't think they're going to pay off the house before they retire, looking at that large income. Should they scale down? Should they just say, you know what, I'm going to sell it, capture the equity, and then put it somewhere where I can guarantee what I can get?
Well, that's why I mentioned, I think one of the most important things that I just mentioned, if it's a single unit, that means at the end of the day, if that property, I don't care how much you owe on it, if there's no tenant and there's no income coming in, multiplex is a little bit different because there's a lot of cash flow coming from different sources of income. So I would say to her, if it's a single unit, meaning it's a one family house and she's looking to refinance and she's only one source of income coming in, I definitely refinance and take the lower payment. If it's a multi-unit, I would probably pay the debt off, because now if it's a 4-unit building, I got 4 sources of rent coming in on a monthly basis, which could be a substantial cash flow. So it all depends on what the property is, how old you are you married, the additional income coming in. All those things kind of go into a more qualified answer, so I can kind of beat around the bush based on the limited information that I have.
It's a great email, but I think it is missing a couple of factors, like what is your retirement going to look like? What are the other sources of income? When are you going to retire? Do you have health issues? I mean, these are some of the things that come up that might determine what you actually do.
Do you have kids that are looking for that inheritance? A lot of those things you've got to think about.
You'd be surprised how often that comes up. But
Absolutely.
It usually comes up near, when there's a ton of equity there.
Well, I've came across a number of situations where people have called me, elderly people have called that are struggling with their homes, and of course, and those particular circumstances that those people are limited fixed income. It seemed to me the best advice I could give was a reverse mortgage. But when they went back and talked to the kids don't want a reverse mortgage. They're going to take your property, Mom. They're going to do this. They're going to do that. I said, if that's the case, then if that was the case, your child should be actually assisting you in paying that mortgage. But if not looking to do assistance, you need to make sure you can stay in the house. Definitely, the reverse mortgage is the thing for you. They don't take your house. They do give you time to pay. They give the kids a chance to refinance the property. They have up to a year to do it. So it's kind of really bad information they're getting, simply because it's information is based upon their benefit and not the parents' benefit with actually living on the property.
So I would tell this person one more option. That is, why don't you take, if you're comfortable with what you have, and you are cash flowing right now, it may not be as the $1,000 a month you're looking at. Maybe it's less. Why aren't you putting that? Can you put that towards the balance every month and accelerate the payment? That could be another option. Or maybe the rate does drop enough where you are to make the savings, and then accelerate it even more, or shorten your term. So there are options, and that's what this low rate environment is doing right now, Gordon. It's giving a lot of people options, and yeah. It's tough out there as an investor right now because you're looking at spotty rents, with the CARES Act, and a lot of people are struggling with some, higher water. You talk about higher water bills, and a lot of places are rent controlled, and their bills keep going up. What do we do? But the low rate environment gives a lot of people those options.
Yeah, we talked about that last week. I talked to a lot of landlords. They're saying they're paying the water bill as people are working from home. They're using more water. I can't raise the rents. They're piling up more garbage. Now I have to bring an additional garbage service now to take care of this. Once again, that's an additional burden on the landlord, a benefit to the tenant, but more wear and tear on the property. There's a whole lot of different things you can look at things. That's why behind every dark cloud is always a silver lining. Behind every single line is always a dark cloud that's actually created.
We appreciate all the emails you sent us. You can always shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We appreciate all the feedback. It's going to be an interesting year because I think, we were looking, before 2020 started, we were looking at how we were going to get back to the norm. Now we have a different.
There you go with that word
I
again.
know, but we were looking for that because we were still looking at low inventory. Now it's even lower. We were looking at decent rates. Now they're even lower. Now we were looking at a comeback of inventory, and that's not there. That's one of the missing pieces in our, especially affordable housing. That's another issue. Is affordable housing.
Affordable housing, we haven't touched that yet. The government has never done anything to affect affordable housing, so affordable housing is going to be struggling
Amazon came out and said they're going to pledge $2 billion.
We'll see.
In the markets they're at.
We'll see.
We'll come back next week. Thanks for joining us. You can always shoot us an email, Tony or Gordon at BayAreaLoanSource.com, or call the show, 800-516-1220. Thanks for being with us. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. We'll see you next week.